Picture this. While silver trades at around $72 per ounce on public markets, one of the world's largest banks quietly accumulated over 750 million ounces worth of physical silver. That's roughly an entire year of global silver production, held by a single institution. Now, here's where it gets strange. During the same period, the public price barely moved. How is that possible? Today, we're diving into one of the most fascinating mysteries in commodity markets. JPMorgan's silver position and why what happens behind institutional doors doesn't always show up on the price tags we see. The silver market has long been a source of controversy, speculation, and frankly, confusion. Unlike gold, which primarily serves as a store of value, silver occupies this unique dual role. It's both a precious metal and an industrial commodity. It's in your electronics, your solar panels, your medical equipment, and yes, still in some investment portfolios. But here's what most people don't realize. The silver market is remarkably small. The entire above-ground investment silver supply in the world is worth only about $100 to $150 billion. To put that in perspective, that's less than the market cap of many individual tech companies. Apple could theoretically buy every investment-grade silver bar in existence with less than 2% of its market value. The small market size becomes critically important when we start talking about institutional players, because when banks the size of JPMorgan Chase enter the picture, their footprint is enormous relative to the market they're stepping into. Before we can understand JPMorgan's position, we need to understand how the modern silver market actually works. And I promise you, it's nothing like buying a silver coin at your local dealer. The silver market operates on multiple levels simultaneously. At the bottom, you have physical silver actual bars, coins, and industrial supply. This is what most people think of when they think silver market. But sitting on top of this physical market is a much larger derivatives market, a complex web of futures contracts, options, and over-the-counter agreements that, on paper, represent far more silver than physically exists. Let's break this down with some numbers. Annual global silver production is approximately 800 to 850 million ounces. Global silver demand, including industrial use, jewelry, and investment, runs roughly 1.2 billion ounces. But here's where it gets interesting. On the COMEX futures exchange alone, the daily trading volume often exceeds 150 million ounces. In a single day, traders exchange contracts representing nearly 20% of annual global production. In a week, paper silver trading can exceed the entire year's production. This creates what economists call a fractionally reserved market, much like banking. For every actual ounce of physical silver that exists, there are multiple claims on that ounce through derivatives. Most of these paper contracts never result in actual delivery. They're settled in cash. Traders buy and sell price exposure, not metal. Now, here's the crucial part. Price discovery happens primarily in this derivatives market, not in the physical market. When you check the silver price on your phone, you're seeing the price determined by futures contracts on the COMEX, not by people buying physical bars. This matters enormously because it means the price can be heavily influenced by players who never intend to touch physical silver at all. Let's rewind to 2008. The global financial crisis hits, and among the casualties is Bear Stearns, an investment bank with a massive commodities trading operation. JPMorgan Chase acquires Bear Stearns in a government-facilitated rescue deal. And with Bear Stearns comes something interesting, a large short position in silver futures. A short position means betting that prices will fall. You're essentially borrowing metal or contracts representing metal and selling it, hoping to buy it back cheaper later. Bear Stearns had accumulated one of the largest concentrated short positions in COMEX silver history. When JPMorgan took over, they inherited this position. Now, here's where the story takes an intriguing turn. Over the next several years, from roughly 2011 onwards, something fascinating happened. While JPMorgan maintained and even expanded significant short positions in the futures market positions that were openly reported to regulators, the bank simultaneously began accumulating physical silver on an unprecedented scale. How do we know this? Well, warehouses must report their holdings. And observers tracking warehouse movements noticed something extraordinary. Vast quantities of silver began flowing into JPMorgan's COMEX warehouses and other storage facilities. We're not talking about small amounts. Between 2011 and 2025, estimates suggest JPMorgan accumulated somewhere between 600 million to over 750 million ounces of physical silver. To put this in perspective, if the upper estimates are correct, JPMorgan accumulated more physical silver than many countries have in their entire strategic reserves. This created a remarkable paradox. JPMorgan was simultaneously the largest shorter of paper silver and potentially the largest holder of physical silver. They were betting against the price with one hand while accumulating the metal with the other. So how does this actually work? How can an institution simultaneously bet against an asset while accumulating it? Let's walk through the mechanics, step by step. Imagine you're JPMorgan's head of commodities trading. You know that the silver market is small and that price discovery happens in the futures market, where you have significant influence through the sheer size of your trading activity. Here's what you might do. Step 1, short the futures market. You take large short positions in COMEX silver futures. When you do this with sufficient size, you create downward pressure on the paper price. Other traders see large sell orders, algorithms respond, momentum traders pile on, and the price drops. Remember, most futures contracts never result in delivery. They're just bets on price movement settled in cash. Step 2, stand for delivery. Here's where it gets clever. While holding these short paper positions, you simultaneously use some of those same futures contracts to actually take delivery of physical silver. On the COMEX, buyers can demand actual metal delivery, though most don't. JPMorgan did repeatedly and in massive quantities. When prices dropped due to their shorting activity, they acquired physical metal at lower prices. Step 3, off-exchange accumulation. Beyond the COMEX, JPMorgan also bought physical silver directly from miners, refiners, and other sources in private transactions that don't immediately affect the public spot price. These over-the-counter deals, conducted away from exchanges, allowed them to accumulate without moving the market against themselves. Step 4, rinse and repeat. This strategy appears to have been executed over years. Short the paper market, suppress the price, accumulate physical at lower levels, cover some shorts, repeat. The volatility this creates also generates trading profits on the swings. The beauty of this strategy, if you're JPMorgan, is that the paper market is much larger than the physical market, so relatively modest amounts of physical buying could be masked by aggressive paper selling. The price signal that physical demand was surging never made it through to the public price because the derivatives market, where price is set, was being heavily managed. Now, you might be thinking, isn't this illegal? Isn't this market manipulation? Well, that's where things get complicated. JPMorgan has indeed faced consequences. In 2020, the bank agreed to pay $920 million to settle charges brought by the Department of Justice and the Commodity Futures Trading Commission, CFTC. The charges included spoofing, placing orders they intended to cancel to create false impressions of supply and demand. Multiple JPMorgan traders were criminally charged, and some went to trial. But here's what's crucial to understand. The settlement and charges focused on specific trading tactics, spoofing, over certain time periods, not on the broader strategy of being simultaneously short paper and long physical. That position structure itself wasn't illegal. In fact, it's a legitimate trading strategy known as a basis trade or cash and carry arbitrage when done within regulatory bounds. The line between aggressive legal trading and manipulation is genuinely blurry in commodity markets. Large institutions are allowed to hold large positions. They're allowed to take delivery. They're allowed to be short futures while long physical. The question is whether they're using their size to artificially move prices through deceptive practices. That's where spoofing crossed the line. Despite the settlement, the underlying accumulation of physical silver continued, and observers noted that JPMorgan's physical stockpile appeared to survive the regulatory scrutiny largely intact. The bank paid the fine, fired some traders, but the metal? That stayed in the warehouse. This brings us to the core mystery. How could such massive institutional accumulation occur without sending the price soaring? If someone cornered 750 million ounces of any commodity, wouldn't Economics 101 suggest the price should explode upward? To understand this, we need to grasp 3 critical concepts about how commodity markets actually function in the real world. First, the derivative tail wags the physical dog. In modern commodity markets, derivatives volumes are so much larger than physical volumes that derivatives determine the price. If you have a ratio of 100.1 or higher of paper trading to physical trading, the paper market controls price discovery. JPMorgan's physical buying was a fraction of daily COMEX volume. Their short positions in the derivatives market were large enough to offset any price pressure from physical accumulation. Think of it like this. Imagine a small lake, physical market, connected to a giant ocean, derivatives market by a channel. The water level is determined by tides in the ocean, not by someone filling buckets in the lake. JPMorgan was bucketing water out of the lake, while simultaneously creating low tide conditions in the ocean. Second, timing and dispersion. The accumulation happened over nearly a decade. JPMorgan didn't buy 750 million ounces in a week. That would be impossible without moving the market. They bought steadily, persistently, during dips, during quiet periods, through multiple channels. This distributed approach prevented any single spike in demand that would alert the broader market. Moreover, they often accumulated during periods of negative sentiment when other investors were selling. During 2011-2015, for instance, many silver investors were liquidating positions after silver peaked at nearly $50 per ounce in 2011 and then crashed. JPMorgan was buying while others were selling, helping to absorb supply without pushing prices up. Third, information asymmetry. Most market participants simply didn't know this was happening in real time. Warehouse data exists, but requires expertise to interpret. Short position data is reported in aggregate CFTC commitments of traders reports, but individual entity positions aren't disclosed except to regulators. The physical accumulation was only pieced together years later by dedicated researchers tracking warehouse movements. By the time the broader market understood the scale of JPMorgan's position, much of the accumulation had already occurred. And even then, without a clear catalyst to make that information actionable, it didn't immediately change trading behavior. Fourth, the structural short position. There's always been significant short interest in silver from industrial users hedging their price risk, miners pre-selling production, and other legitimate commercial hedgers. JPMorgan's shorts could blend into this background activity. When industrial users need silver and want to lock in prices, they short futures. This is normal and expected. JPMorgan's activity, while larger, didn't appear anomalous enough to trigger alarm bells for most observers. This situation reveals something profound about how modern financial markets actually work versus how we think they work. We tend to imagine markets as transparent places, where prices reflect supply and demand in real time. But in reality, modern markets are layered systems where derivatives markets, physical markets, and information markets all interact, and they don't always synchronize. The silver market situation demonstrates what some call two-tier pricing. There's a price for paper silver, the price you see quoted, determined by futures markets dominated by large institutional traders. And there's a price for physical silver, which often involves premiums over spot price when you actually try to buy physical metal, especially during high demand periods. During periods of stress, these two prices can diverge significantly. In March 2020, for example, during the COVID pandemic panic, paper silver prices dropped while premiums on physical silver coins and bars skyrocketed to 50% or more over spot price. You could sell paper silver for $14 per ounce, while physical silver was selling for $21 per ounce, if you could find it. This reveals that the paper price isn't exactly the real price in the way we usually think about prices. It's the price of price exposure, the price of leverage, the price of a bet. The physical price is something different. It's the price of actual metal you can hold. JPMorgan's strategy exploited this disconnect. They could influence the paper price through their trading activity while quietly accumulating physical at levels disconnected from underlying physical supply and demand. Fast forward to January 2021. A group of retail investors, coordinating on Reddit's Wall Street Bets and later Wall Street Silver, became aware of the concentrated short positions in silver. Inspired by the GameStop short squeeze, they attempted to squeeze the silver shorts by buying physical silver and silver ETFs, betting that delivery demands would force shorts to cover at higher prices. The movement gained significant traction. Physical silver premiums exploded as retail demand surged. The largest silver ETF, SLV, saw massive inflows. But here's what's interesting. The COMEX silver price spiked briefly to around $30, then stabilized. The squeeze didn't produce the explosive price gains many expected. Why? Several reasons, but one stands out. The physical silver that retail investors demanded had to come from somewhere. And guess who owned a significant portion of available physical supply? JPMorgan had positioned themselves as both a potential target of the squeeze, through their derivatives positions, and a beneficiary through their physical holdings. They could supply physical metal into the rising demand without the squeeze forcing short covering at panicked prices. This demonstrated the genius or the concerning nature, depending on your perspective, of their long-term strategy. By controlling significant physical supply, they had optionality. They could supply metal to meet delivery demands. They could lend metal to those needing to make deliveries. They could cover their own shorts without buying into a squeeze. Since 2021, silver prices have remained volatile but generally range-bound between $20 and $30 per ounce until 2025, when prices surged over 140% due to industrial demand and supply shortages. The supply that JPMorgan accumulated over a decade provides a buffer that may be absorbed into the market gradually, preventing the supply squeeze that some have predicted. So where do things stand today in 2025-20? JPMorgan remains one of the dominant players in silver markets. Though the exact current size of their physical position is unknown, they're not required to publicly disclose it. What we do know is that they fundamentally restructured the silver market through their decade-long accumulation. Several factors are creating new dynamics in silver. Rising industrial demand, silver's industrial applications, particularly in solar panels and electronics, continue growing. Each solar panel requires roughly 20 grams of silver, and solar installation capacity is expanding rapidly worldwide. This creates genuine physical demand that can't be satisfied with paper contracts. Supply constraints. Most silver is produced as a byproduct of other mining operations: copper, lead, zinc. As some of these mines mature or face declining ore grades, silver supply growth is constrained. New primary silver mines are rare and expensive to develop. Monetary demand, concerns about inflation, currency devaluation, and financial system stability continue driving some investors toward precious metals. While gold dominates monetary demand, silver attracts interest due to its lower price point and higher volatility. Market structure reform. Regulators have increased scrutiny of commodity markets following the JPMorgan case and other manipulation scandals. Position limits, reporting requirements, and enforcement have all strengthened. Whether this prevents similar situations in the future remains to be seen. The big question hanging over the market: what will JPMorgan do with their physical position? Will they hold it indefinitely as a strategic asset? Will they gradually supply it into the market? Will they use it to maintain influence over market dynamics? The answer affects pricing for years to come. The JPMorgan Silver Saga teaches us several important lessons about how modern financial markets actually function. Lesson 1: size matters. More than theory. Economic textbooks teach us that prices are set by supply and demand. That's true, but in modern markets, the demand that matters most for price setting isn't necessarily end-user demand. It's demand in derivatives markets, where a few large players can have outsized influence. JPMorgan wasn't able to defy gravity permanently, but they were able to create their own temporary weather system in a small market. Lesson 2. Information isn't always power. Even when some investors figured out what was happening, that information didn't immediately translate into market impact. The structure of the market, how prices are formed, who has what advantages, where liquidity exists, matters more than information alone. Knowing JPMorgan was accumulating physical silver didn't tell you whether prices would rise tomorrow, next month, or next year. Lesson 3. Regulation has limits. Despite regulators, despite oversight, despite high-profile cases and substantial fines, determined institutions with sufficient resources and expertise can still execute strategies that push against the boundaries of rules. The regulatory system is designed to prevent fraud and manipulation, but it struggles with activities that are individually legal but collectively produce outcomes that look like manipulation. Lesson 4. Physical and financial markets are divorcing. Increasingly, physical commodity markets and financial commodity markets are becoming separate systems that only intermittently sync with each other. This has implications far beyond silver. It affects oil, agricultural commodities, and other essential materials. When paper markets dominate price discovery, but physical markets determine real-world availability, we create systemic fragility and potential for disruption. We opened with a mystery. How could institutional activity at such massive scale not move the public price? We've explored the mechanisms, the market structure, the regulatory landscape, and the strategic execution. But in some ways, the mystery persists. Not because we don't understand what happened, but because what happened reveals how much our markets are not what we think they are. The silver market is tiny compared to stocks, bonds, or even other commodities. Yet even in this small market, price discovery is so dominated by derivatives trading that physical reality becomes secondary. What does this say about larger markets? If institutional players can accumulate 750 million ounces of silver without dramatically moving prices, what similar dynamics might be playing out in gold, oil, copper, or even currencies? The JPMorgan silver case is ultimately a story about the gap between appearance and reality in modern finance. The price you see on your screen represents something, but that something might not be what you think it is. It's not exactly supply and demand in the traditional sense. It's the price of contracts, the price of leverage, the price of sentiment and positioning in derivatives markets where large institutions operate with advantages that fundamentally shape outcomes. For retail investors, this might seem discouraging, and in some ways it should be. You're not playing on a level field. The market microstructure, the information asymmetries, and the sheer scale advantages of major institutions create conditions where their strategies can work for years before broader markets catch on. But there's also a deeper truth here. Ultimately, physical reality asserts itself. Paper markets can diverge from physical markets, but not forever. If demand for actual silver continues rising while supply remains constrained, no amount of paper market engineering will create physical metal that doesn't exist. The question is timing and whether you can maintain your position long enough to see physical reality reassert itself. The silver market will continue evolving. Industrial demand growth, supply constraints, regulatory changes, and shifting investment sentiment will all play roles. And somewhere, in warehouses around the world, sit hundreds of millions of ounces of silver that JPMorgan accumulated during a decade-long strategy that most market participants never fully understood while it was happening. That silver represents many things: a successful trading strategy, a concerning demonstration of institutional advantage, a buffer against supply shortage, or perhaps a speculation on future value. What it definitively represents is the distance between how we think markets work and how they actually work. And that might be the most valuable lesson of all. In markets, as in much of life, things are not always as they seem. The prices we see, the information we have, and the stories we tell ourselves about fair markets and price discovery, all of these exist in tension with underlying realities that are far more complex, far messier, and far more controlled by those with scale and sophistication. So, the next time you check the silver price on your phone, remember, That number represents something, but what it represents is far stranger and more interesting than you might think. Behind that simple number lie warehouses full of metal, billions of dollars in derivatives positions, decades of institutional strategy, and the ongoing question of when or if the paper market and physical market will finally meet again. The story of JPMorgan's silver position isn't over. It's still being written, 1 ounce at a time. If you found this deep dive fascinating, you might want to explore how similar dynamics play out in other commodity markets, or how the same principles of derivatives dominance affect everything from oil prices to agricultural futures. The world of institutional commodity trading is vast, complex, and mostly hidden from view. But once you understand the patterns, you start seeing them everywhere. Thanks for watching.